Hi traders, it's Roberto for Forex Circle. This tutorial will focus exclusively on candlestick patterns. So let's get started. We are looking for candlestick patterns that will indicate either a retracement or referral, and we're going to be looking them at different time frames. We're going to start on the 1 hour chart. This RR refers to railroad tracks, where we have one green candle and one red candle. Oftentimes it doesn't even matter what the candle is, as long as there are two candles side by side. But this candle pattern needs to be qualified. Some don't have to be qualified, and we need price to break below, and there it was. There was a trade. So this is a reversal pattern. Price turned around. Notice when it went back up, it never broke above the swing high, and you needed to wait at least a day before you were in profit on this trade. And market just shot down from there over 100 pips. How do you qualify these trades? You don't want to trade any of these candle patterns when the market's in consolidation, because that's a completely different strategy. Here, the market started down here, went up about 77 pips, and it gave us a railroad track. It was also a color change candle, and you would trace a trade 8 pips below. Okay, let's move on. This is called a bearish engulfing candle. Notice that from here, all these small candles, and it took forever for price to reach this level, only to be completely taken away, all these profits completely taken away by one candle. Okay, 1/10 of the time, and almost twice the move. This is called a bearish engulfing candle. It is a reversal candle. And notice that, why is it called engulfing? Because look how many candles it engulfed. All these small candles was inside this bearish candle. And you would place a trade on the next candle. Oftentimes I like to wait for a 50% retracement of this red candle. And it went up about 30%. And there's your trade, 100 pips. Let's look at what is commonly known as the inside bar. Okay, so I'm going to have all of these labels so you can refer to them. Inside bar or baby candle. Okay. Now this inside bar occurs when it falls inside, it prints inside the previous candle. So this is called an inside bar. Market goes up. We have a color change candle, which is even better. And then what do we do? If you don't trade the color-coded trade, let's say you missed this trade and it was all the way down here by the time you saw the setup, then you draw a horizontal line top and bottom of that inside bar. This is called the mother candle. This is an inside bar. And you place a trade when price breaks below the mother candle. And there's your trade. Oftentimes I just take the trade at the break because it is a color change candle already. So technically I would have gotten in like here, but it's okay to get in at when it breaks the swing point. And there's your trade, 129 pips. Okay, so we have 3 candle patterns, reversal candlestick patterns: bearish engulfing, railroad tracks, inside bar, or baby candle, which makes this long candle a mother candle. Okay. The next one is, well, we need to find it, so 1 second. This is the pound USD. And notice these two, oops, excuse me, let me just move back to where that chart was. Yes. Bear with me just 1 second. Let me just pull up that area that I was looking at. Well, let me just do this one now, and then we'll get back to the one I was thinking of. Okay, here we go. Notice these 2 wicks up here and these 2 wicks up here. These are what are commonly known as tweezer tops. When we have wicks that are almost equal in length, so we call them tweezer tops. Okay, those are also reversal patterns. Okay, Here's one and here's one. And how do we qualify them? Well, it's quite simple. You just draw a horizontal line and you would take a trade on the next candle, but your stop loss needs to be above these tweezer tops. Notice also that it's at a supply and demand indicator, so that helps a lot. So price started down here. Again, you don't want to trade these when the markets are consolidating, really. Price shot up about 84 pips. Try to break the highs and it failed. Try to break it again and it failed. Gave us tweezer tops. This one here is more like a false break, and eventually the market sold off. Okay, here is another candle, and this is again a bearish engulfing candle. Now there's several things that are happening here. First, we have a color change candle, and you didn't have to wait for this candle to finish, but maybe you missed this trade and you saw this trade later on, maybe here. Then you would qualify this as a bearish engulfing candle because it covered 1, 2, 3, 4, 5 candles, and you would enter your trade on the next candle. And even though you missed this major move, there was still room to trade this. Okay, and it went down about 39 pips. Okay, but this trade, if you would have caught it up here, 1, 2, 3, 4, 5 consecutive green candles followed by color change candle, and you would have entered a trade about there to sell, because it does qualify. It's a color change candle after about 50 pips, something like that. This is an Aussie dollar, so 60 pips is the range on this. Then here, what we have is tweezer tops, 2 candles with wicks that are equal in length. Okay, tweezer tops. Okay, so we have bearish engulfing, tweezer tops. We have railroad tracks, right? And we still haven't gone over the kangaroo tail, the hammer, which I like to call instead an exhaustion candle. Hammer doesn't mean anything to me. It's just something you drive nails through. But an exhaustion candle is name and form. It's exhausted. Okay, small body. I don't like the little wick up here, but that's okay as long as it's up in this range and not down here. And how do you qualify this? Well, this was not much of a run. It went up maybe 14 pips, but it's still an exhaustion candle at a previous resistance, or rather support. And eventually it did turn around and went north after the next day. And this was towards the end of the session, so not much activity, not much volume until the next day. And look at this, it went all the way up here. So this is called an exhaustion candle, which we have a small body and a long wick. And the wick has to be at least twice as large as the body. Okay, so there you have it, exhaustion candle, tweezer tops, 2 wicks that are equal in length, bearish engulfing candle. These are essentially reversal patterns. Okay, I want to show you something which is very important. When you're looking at a chart, and this is a 4-hour chart actually, and you see this reaction, see these levels down here, see how market tried to penetrate the lows and it just could not. 1, 2, 3. Okay, so how do you trade this? Well, the more aggressive approach is to actually just place a trade at these levels and see if market reacts to that level. But if you're a more conservative trader, you want to, make sure that these are real. All you need to do is draw a fib from the high to the low, and there are several areas you could have drawn a trend line, and just wait for the break. We know that price doesn't want to go any lower than this, which is 91.0508 on USD yen. So it's logical to think that this is a very strong support level. Stochastics is oversold. So just 1, 2, 3, 4 wicks violently reacted to these levels. and you would just place a trade at the break of the trend line or place a trade down here because your stop loss would be minimal, maybe 10 or 20 pips. Stochastics indicator is oversold. Okay, that's another trade setup. Just wicks. This is a triple bottom. Okay, before we were looking at Tweezer tops, here are Tweezer bottoms, where wicks are almost, these are almost equal in length. Okay, Tweezer bottoms, where wicks basically are equal in length. I'm sorry, it's supposed to be a Tweezer bottom, not a Tweezer top. Okay. You're looking for price exhaustion. Stochastics oversold. And you have a candlestick pattern that indicates the price wants to turn around. And it's also referencing a previous support level, which happens to be a false break area. Price went up, came back down to the same area. Stochastics oversold, and you buy it. Okay. So when you match up candlestick patterns with stochastics, very powerful. Okay. Here was a false break. This was coming into the London session. Notice that from Tokyo to Singapore, price stalled out. False break, market turned around and went north. Okay. And the one candlestick pattern, I can't find it yet, is an exhaustion candle. Let me look at another chart. 1 second. And here it is. This is what I was looking for. An exhaustion candle or a hammer or a kangaroo tail. Right here. Very long wick. I call it an exhaustion candle because that's exactly what it is. Exhaustion. The market is overbought. I'm sorry, oversold. Here we have several reasons to take a trade going north. First, this candle is longer than this one. That's important. The kangaroo tail or exhaustion candle must be bigger, including the wick, than the previous candle. It may look, so this candle, let's count the pips. 110 pips, and the previous candle was only 78, so it is longer. So you would place a trade around 50%. Because this is such a long candle and it was oversold by the time it closed, it shot up, came back down to a 50% retracement level, and that would be a great entry. Market went up 137 pips. Notice that stochastics was oversold, and we also had divergence on stochastics. Many reasons. Number 1, divergence. Number 2, kangaroo tail or exhaustion candle. Number 3, a color change candle. Okay. And number 4, stochastics is oversold here on both 21 and 14. Okay, that's it, guys. The next tutorial is going to be about divergence. We just covered one right now. And I'm going to be talking a little bit more about psychology about trading. I went over it today in the trade room, and I just want to talk about it more on the next tutorial. Okay, see everyone in the trade room.